evening, everybody. Nice to see you all from different backgrounds, from different geographies, and people actually from different kind of work background also. Some are from audit, some are from accounts. Anyway, nice to see you all. And just to introduce, this is a follow-up session of the session which we had earlier on transfer pricing. That was a 2-hour session. That was a paid session actually. It was a very good session, to be frank. It was done by Mr. Ajin Thomas itself. So after that session, we thought of having up a follow-up session to focus on more key areas with regard to what accountants and auditors should take care of. So that is why we have this session here. And I think transfer pricing is nothing new. Everyone knows about transfer pricing. But recently, after the introduction of corporate tax in GCC, it has become more, there is more scrutiny from the department side, and those who are not compliant earlier also, now they are forced to be compliant. They are forced to keep records, have a transfer price policy, and things like that. So now it has become more complicated, and without having a proper transfer pricing policy, could land you in big trouble actually. So today morning also we had a session with our external consultant. He's there here in today's meeting, with what we can do when we bill to our related party. So generally we bill to our related party without margin, so that the related party can sell it to the end customer at a very competitive price. But when the rule says that you have to do this transaction at arm's length price, then it creates a lot of confusion, and how do we book that and things like that. And today I was speaking with Ajin also. If you do proper transfer pricing, you can actually do a proper tax planning also. So transfer pricing is just not about compliance; it is about tax savings, or tax planning also. So I'm not taking much of your time. For today's session, we have Ajin Thomas. He is a chartered accountant by qualification. Now he is into transfer pricing. He has worked with BDO earlier, and it is a pleasure to have him here. He is an expert in this field. That is why actually we chose him for this session. And by this session, we believe by the end of this session that you will get an idea of, if you are an accountant or auditor, what you should comply in your organization, from where you should start, and things that you should take care. So this will be a more practical oriented session. So again, welcome you all. We have like 50 plus participants. Glad to see you all. Once again, welcome. And yes, over to you, Ajin.
Thank you, Sabiq. Thank you, Sabiq, for your lovely introduction. I'm very happy to see all of you are joined in this webinar after your work. So first of all, I would like to appreciate Sabiq and Ijaz for organizing this webinar and inviting me to take the session. So as Sabiq rightly said before, we were planned for a subsequent sequel of the first webinar which we were conducted in the last month. Then we decided that let's open this transfer pricing webinar for all, because there are a lot of gray areas and a lot of people having pain point of transfer pricing. So that's the reason which we again we put a webinar for all, open for all. So I will just quickly take to the session. So the session will be divided in such a way that first we will discuss the basics of the transfer pricing. So there might be a lot of people who are first joining to the transfer pricing session. So I will be explaining things like basic things of transfer pricing in the first session. So because after knowing the basics of the transfer pricing, then only you will be able to understand the rest of the things. So I will be explaining the basic things in the first session. Then we will come to our today's agenda, how we can create a defensible transfer pricing policies. So then we will be having a Q&A session. And in between, if anybody is having any doubts, feel free to interrupt the session and ask the doubts. There is no worries on that. And I will keep my session in a very low pace mode, because there might be technical terms and there might be people who are not familiar with transfer pricing in detail. So let's begin. Just allow me 1 second to present my PPT. I hope my screen is visible.
Yes, it is visible. GCC transfer pricing audit readiness.
So my first question is, why transfer pricing is required? It's a very basic topic, but let's just start from this. Why transfer pricing is required? So let us understand from an example why transfer pricing is required. So I have given two situations here, situation B and situation A. So let's first analyze situation A. So there are two companies in this case. There is a parent company which is situated in India, and also there is a subsidiary company which is situated in Dubai, and there is a third party customer. So the business model of the company is that parent company sells the product to subsidiary company in Dubai, and the subsidiary company in Dubai sells the product to third party customer in Dubai. So in first case, you can see that in the P&L there is sales, cost and profit. So in the first case, the sale price is 120 rupees, and the expense side you can see the cost is 60 rupees and the profit is 60 rupees. So the effective tax rate in India is 30%. So the tax will be tax at 30% will be 18 rupees. And when it comes to the UAE company's books of accounts, Indian company sold the product to UAE company at the rate of 120 rupees. So the cost will come on the UAE company's books as 120 rupees, and the UAE company is selling it to end customers at the rate of 140 rupees. And the effective tax rate at the UAE region is 9%. So effectively, so the tax will come as 1.8 rupees, 1.8, and the overall tax burden of the group is 19.8. So this is the overall tax burden of the group under situation B. Now let us examine situation A. Situation A, what the company is done? Company is manipulated the sales price to the actual sales price. Sales price by parent company to Dubai is 120 rupees, but in situation A, the company is manipulated the sale price and it put 80 rupees as the sale price to reduce the profitability. So sale price is 80, cost is 60, and profit is 20. So effectively tax rate is at 30%. It comes to 6 rupees, and when it comes to the UA company's books, sale price is 140 and cost is 80, because Indian company sold to UA company at the rate of 80 rupees. So cost is 80 rupees and the profit is 60 rupees. So effectively the tax rate will be 5.4. So the overall tax burden of the group, if you analyze the situation A, the overall tax burden of the group is 11.4. So what happened in this case is that this particular company has manipulated the sale price and reduced the profitability in a high tax country and shifted that profit to a low tax jurisdiction. So in this case, what happened is that governments are losing their tax base. So multinational companies started to shift their profits to low tax jurisdictions. So countries having higher tax rate, tax rates reduced their tax base, so they have eroded the tax base to another countries. So this way, this practice has emerged after globalization. And what happened is that to counter this, every country is introduced transfer pricing regulations. So the purpose of the transfer pricing is to prevent the shifting of profits from higher tax jurisdiction to lower tax jurisdiction. So you understand why transfer pricing is important. So can I move forward?
Just one thing. Can you just explain what arm's length price is for all?
Yeah.
Because you
Yeah.
mentioned that.
Yes. So arm's length price is the price if we are conducting this transaction with a third party. So this transfer pricing basically will apply to the related party transactions. So if we are conducting this transaction with a third party, what price we will be charging? So we can say it as a market price or something, or we can say that it is a price where we charge to a independent third party, so that there will not be any manipulation in case of an independent third party. That is called arm's length price. We can I will go deeper into what is arm's length price in the subsequent slides.
Yeah.
Hope it is.
Just
Yeah.
can I ask one more thing actually? When you said
Yeah.
a related party, it does not mean that he should effectively control, sorry, have shares in that company. Even having common controllership will also be treated as a related party, isn't it?
Yes, right. You rightly said, Sabi. It is like it is the control thing. So we will discuss that in detail in the subsequent slides.
Okay,
So
thank
it's effectively control, not only the voting rights or the shares. It's control only. Okay, can I move on to next slide?
you. Yeah, sure. Sorry for interrupting in between.
Uh, Not an issue, not an issue. So we can clear. Like you can interrupt. Feel free to interrupt and ask questions. I will be more happy to solve all the doubts, so that I can also learn new things. So So I will just give an overview of the TP analysis. What usually as a TP consultant we do when in a TP analysis. So this is the basic concept thing. And so first when we get a client or when we analyze a transaction, first thing we do is the transaction analysis. What is the activity that is performed? Whether whether that entity is a service entity, whether it's a manufacturing entity, or it's a trading entity. And also we will also analyze what are the scope of activities covered in that particular arrangement, whether whether it's what are the scope of services which is covered in that particular arrangement, and also the transaction flow, and which all the entities are involved in that, and also the industry which each entity is operating, and also the pricing mechanism, how it is priced. Is there any remuneration thing? As a next step we will go to the FAR analysis. FAR analysis. So I will say FAR analysis is the fundamental basis of every transfer pricing analysis. Why? Because I will tell you. In FAR analysis, what we will do is that we will analyze which are the functions performed by which are the entities. For example, there are two entities. For example, one is a parent company, which is in UK, and another company is a subsidiary company which is in UAE. So what happens is that UA company is software development services to UK company, parent company. So we will analyze which are the key functions which are adding value to the value to the group. So for example, if we take the case of a software development company, there will be a lot of functions which are adding value to the customer. The first function will be, we can say that the strategic leadership. Strategic leadership is a key function which add value to the organization. Second thing is the requirement analysis. First, before starting the software development activity, we will do a requirement analysis. So that thing will be there. After that thing will be, after that thing, there will be like customer contract negotiation and all, that will be there. And after that, coding will be there. And after that, testing will be there. And as a last, documentation will be there, and also customer support services will be there. So this is the functions performed in a software development arrangement. where subsidiary company is providing software development services to parent company. So in this, we will analyze which entity, whether it's a UK entity or the UA entity, which entity is performing which functions. For example, if we take this particular case of a software development, we can say that the strategic leadership will be performed by UK, because like in this arrangement, strategic leadership is performed by UK, because all the key managerial persons, or the CEO or the COO, managing director, all the key employees are sitting in UK, and the UK all are employees of that UK entity. So strategic leadership activity is performed by UK. And also then the requirement analysis is direct client interaction is by UK entity. So it will differ case to case, but for example, for this case we are taking this example. So requirement analysis will be performed by UK. And coding, next is contract will be entered by UK with their customer, because this UA entity is just only an offshoring entity where they work under the direction of the UK entity. So contract negotiation will be undertaken by UK entity, and then the coding part will come. This coding part will take care by the UA entity, and also the testing part will also be taken care by the UA entity, and also the documentation part also will be taken care by the UA entity. So in all this coding, testing, and documentation, there will be a instruction from the UK. So in which manner that coding or testing or documentation to be done. So in this case, when you analyze this transaction, key functions like strategic leadership, requirement analysis, and instruction giving, everything is performed by UK entity. UA entity is acting as only an offshoring entity which provides services to its parent company under the direction of the parent company. So in this, we can say that key functions are performed by UK entity, and where only main functions are performed by the UA entity. So why we are doing this FAR analysis? In TP, in TP and in the international taxation, the common principle is that whoever does more functions, and whoever employs key assets, and who bears more risk, that particular entity in an international transaction is eligible for higher returns and more profits. And the entity which is less bearing these functions and employing only routine assets and bearing only very limited risk is eligible only for a minimal profit. So this FAR analysis creates the basis for every TP and every transfer pricing analysis. So we will analyze what are the functions performed by each entities and what are the assets employed. Maybe in this case, maybe UK entity might be the owner of the intangible property. So we will detail that in our transfer pricing study. Then we will also analyze which entity is bearing more risk. So there will be a lot of risk, like foreign exchange risk, market risk, intellectual property risk. If something happened to their intellectual property, which entity is going to bear that risk? So in this case, UK entity is the owner of the intellectual property. So UK entity will be bearing that risk. So these things we will analyze in a functional analysis, and based on the functional analysis, we will go to next steps like characterization of the entities. We will characterize the entity, whether it's a high-end entity or it's a low-end entity. What means high-end and low-end means? Low-end is something which is like limited risk only. They are taking limited risk, and they are eligible for only a limited profit. And high-end entity is an entity which is doing significant functions and which is eligible for a higher return. So based on this, we will characterize, and after that we will go to economic analysis. In the economic analysis, we will select. So in transfer pricing, we need to justify the arm's length nature of the transaction by using any of these methods mentioned here. So there are 5 methods mentioned by the OECD guidelines, and also one more method, other method, which is approved by the tax authorities in the GCC countries. So this is the thing, and after this selection of TP method, we will select the tested party. Tested party is the party which is a very least complex entity in a transaction. In this case, UA is the least complex entity because it does not own any intangibles, and also it bears only limited risk. So we can characterize UA entity as a limited risk entity, and in this particular case, UA entity will be selected as the tested party. Then we will select the PLI. So PLIs will be their operating profit divided by operating cost. Operating profit divided by operating cost is one PLI, and operating profit divided by operating revenue is another PLI, and also operating profit divided by assets employed is another PLI. So which PLI is suitable for us, that we will select. Then after that, we will take the selection of TP database. There are a lot of TP databases like TP Catalyst, Profess, like that. So we will select which database we need to use to select our comparables, and we will search the comparables in this particular database, and we will do a comparability analysis, and we will select the most appropriate comparables for our company, and then we will find out the arm's length range. This is the process which is covered in every TP analysis. And if anybody is having any doubts, I will just pause for a second. You can ask me any doubts in this particular portion.
Can you please help me out with what is the difference between the related party and the tested party?
So in this case, so let's take an example of UK and UAE. In this case, UK entity, this parent company and subsidiary company, both are related parties. Okay. And in this case, there could be only one tested party. We need to select one person as a tested party. So in this case, this subsidiary company is the least complex entity because it is bearing only low risk, and also it does not own any intangible properties. So we select UA entity as the tested party. So this tested party's business, just one second. So this tested party's business, we will search comparables for this tested party. Like for example, this company is doing a software development service, right? Software development service. So we will search comparables who are engaged in the software development process. So tested party is the one which we will find out the margins of this tested party, and then we will search for comparable companies who is doing similar functions and similar services to this tested party, and we will analyze the transaction. Hope it is clear for you.
Yeah, thanks.
Okay, so I will move on to next slide. Just one second. So in the initial portion of our session, Sabiq was asking a doubt of arm's length. So how we can say that one transaction is at arm's length? So what is the core concept of this arm's length? So first we need to identify related party. Which all are related parties? Or in UI transfer pricing law, there is one concept called connected person also. So which all are related parties? So in this related party, not only this voting rights or not only the share capital percentage, we need to identify whether that particular entity is able to control the other entity. So the primary focus is on the control. If that particular entity is able to control another entity, through its board composition or through its funding, or if that particular entity is the only vendor to this entity, all these cases, it will, this transfer pricing, it will come under the ambit of transfer pricing. So the definition of the related party, rather than giving what is mentioned in the law, we need to give more preference to the substance should be given more preference. That is the first thing which I want to say in terms of related party. And also I want to tell all of you that transfer pricing is not an exact science. So there is no hard and fast rule which says that this should be done in this way. So everything will be different to case. So we need to give more preference to substance. So what is actually happening? So there are cases in which one in contract they will say that this is the service, but in actual there will be giving different services. So in transfer pricing, what we will do, we will take the actual service which is provided by entity rather than what is mentioned in the contract. So we need to give so when auditor's point of view, I'm saying from the auditor's point of view, so you need to check whether what is actually performed by that entity rather than simply relying on the contract. So TP analysis follows the what is actually done. Okay, for example, in this case, like we can say that like if there is a management charge, management services, we are saying that this management is sitting in UK and management is providing a management services to UA entity, but in actual it is not there. So we will go with the actual one. So this UK entity cannot charge a fee on the UA entity stating that I am providing this management fee services. So we will go with what is actual. And the second thing, as I earlier said, so substance should be given more priority. So there are cases where some entity, like for example, there is a holding entity and there is a subsidiary entity, and there are another subsidiaries, 3-layer subsidiaries. So when you see the legal ownership, ultimate owner is this particular entity which holds entire group. So in transfer pricing, we should give, so capital is sitting on this particular entity, and this is ordered by subsidiary company, and there are 3 other subsidiary companies. So in this case, this whole group's capital is sitting in this particular parent company, but all the functions, like whether all the functions, key decisions, key employees, and all the functions are undertaken by this entity. So our TP analysis should allocate the profit to this entity, not this entity. Why? Because capital, so we need to give more emphasis on the what is the function, what is the value created by entity, and which entity is bearing more risk rather than capital. So some might be have a assumption in their mind that since this company is holding entire the group, this is the ultimate owner of this company and this company should get maximum profit. It's not the case. It's not that the case. Capital is not a matter for allocating profit. Allocation of profit should be based on the functions, assets, and the risks performed by each entity. So our primary focus should be given to functions, assets, and risk rather than any legal ownership or legal capital holding. So these are the things which I want to tell you in this arm's length scope. I will move to next slide. Then there are methods. I'll just quickly discuss what are the methods available in transfer pricing. There is cup method, resale price method, transactional net margin method, and profit split method, and also the other method also, cost plus method also there. So in case of a cup method, we are directly comparing with a similar product or similar service which is there. So direct comparability and strict product comparability is required in this cup method. So that is why, so the one point in cup method is that we need a strict product comparability. That is why sometimes it will be very difficult for us to apply cup method for a service transaction, because service transaction is a very subjective thing, and it may not be matches with the other person. Even though, like for example, I am providing consulting services, another person also providing consulting services, so there will be still, we both are providing consulting services, there will be differences between both of us. So cup method required uh, strict product comparison, so it makes it's very difficult for to apply in transactions like service transactions. So it is most commonly used with the interest rate, and also with the more of commodities, and for simple services where there is not that much complexities are there. Then resale price method and cost plus method. So both these methods compares the gross profit levels. So this resale price method is applicable, most commonly used in case of distributors, when a subsidiary company or when a company purchases from its related party and it resells to third party customers. And cost plus method is commonly used in case of when we are doing any assembly functions, and where the cases where our indirect cost is very less. And the most commonly used method is the transactional net margin method, where we analyze the profitability of the comparables at the net level. So the PLA we will be using is the operating profit divided by the operating cost. So net level profitability we will analyze, and it is the high and common method which is used in practical case. In practically we use TNM mostly because of its lot of its advantages. So these are the methods, and also there will be question in your mind that which method I need to give preference. If I can use cup method and also I can use TNM method, which method I need to give more preference? So my answer is that if you are able to use cup method effectively, then your first priority should be given to the cup method. Then after that, RPM and cost plus method should be given the priority, and after that only transactional net margin method should be given priority. So that is the priority case. But in practice, there will be difficulty to get comparables in cup and RPM, cup RPM and cost plus, because especially in case of GCC countries, we don't have that much data availability. So data availability of gross margins of comparable companies. So there will be difficulties to use cup and resale price method in case of GCC. And also one thing which you need to take in care is that if there is a uh, internal cup, always you should clearly document that why you have selected TNM rather than an internal cup. So what is an internal cup means that you are selling a product. For example, uh, you are selling an electronic product, for example mobile phone. You are selling a mobile phone to your related party as well as your third party. So the comparable is available in your company itself, because you are selling the same product to your related party and your unrelated party. So that is called internal cup. So if there is an internal cup in your organization and you are selecting transactional net margin method to justify your arm's length range, like justify your arm's length price, there should be clear documentation which states that why you are rejecting internal cup, because the authorities may come up tomorrow and ask what is the reason for rejecting this internal cup, because that is something which is already readily available for you, and there is no issues of uh, data availability. So that is a point which you have to take care in case of method and selection. I'll just move to another slide. So I just given a slide which each method is best suited in which all the cases. So cup method is used in mostly in commodities and loans. And RPM method is used in buy sell distributor models, like I'm purchasing from my related party and selling to my unrelated party. And CPM method is used by manufacturers, where there is very less indirect cost. All the cost all the cost gets assumed in direct cost itself. So in these cases, CPM method is used, and transactional methods is mostly used in all of the cases, mainly because of the non-availability of data for other methods, CPM, RPM, and CUP. So PSM is something which is used in case of a creation of an IP, and which you are doing a very complicated functions. It is mostly applied in cases of joint ventures. For example, if a UAE entity and a Saudi entity both are engaged in creation of an IP, then the profits derived from the exploitation of that IP should be distributed using profit split method. Other method is something which, if we are not able to justify our arm's length nature of the transaction using these methods, then we can relate to other method. Other method can be anything. For example, in case of employee stock options, we use valuation reports. So other methods can be anything, like public databases, anything we can use. And it is used as a corroborative thing, and as well as if we are not able to justify our arm's length through other prescribed methods. So hope everything is clear for you. If anybody is having any doubts, I will just pause and you can ask any doubts. If nobody is having any doubt, I will move forward. I think no one has doubts. I will just move forward. So these are the basics of transfer pricing, which I have taken in a like very quick manner due to the shortage of time. But I hope everyone has understood the basics of transfer pricing. And then now we will come to today's our agenda. So our objectives of today's session. So our key objectives are, we need to understand how best we can create a defensible TP framework. How best we can create a defensible TP framework. And also, there are a lot of auditors who are there in this webinar, who are in this webinar. So I will be discussing from an auditor's point of view, what all the audit evidence and controls you have to check. And there are certain nuances from each particular to each jurisdiction, which also we need to analyze. So there are jurisdictional nuances which we will be analyzing in our subsequent slides. So just let's start. So what you understand by a defensible position? So if you are able to comply with the 4 items I listed here, you are defensible. First thing is that you have to comply with the TP rules of your tax jurisdiction. If you are a company present in Saudi Arabia, you have to follow the specific transfer pricing rules issued by the Saudi authority. And if you are a company in UAE, you have to follow the rules issued by the Federal Tax Authority. So all these rules are based on the OECD guidelines. So India is a country which does not accept OECD guidelines, but this KSA and all the GCC countries accept OECD guidelines. So the basis for all countries TP law is OECD guidelines. And second thing is the substance based. If your TP policy is substance based, which means that so you are allocating more profits to where the value is created and where the key peoples are sitting and where the high risks are controlled. So this is nothing other than the FAR analysis. So in your TP analysis, you should have to do a proper fair analysis, and you have to determine which entity is creating more value to the group, and which entity has key resources, key people are sitting in which entity, which who are in the ideation stage and who are in the strategic leadership of that entity. So that thing we need to analyze, and also we need to analyze which entity is bearing high risk. So once you analyze all this and you create a TP policy which aligns with this key functions, then that test is also completed. Substance basis is also completed. And the third one is it should be supported by documents. There should be proper contemporaneous master file and local file. So that is a point which we need to point, which I will repeat again. Contemporaneous master file and local files. You can't prepare the master file after 4 or 5 years. It should be prepared along with your corporate tax return. So if local file or master file, which we will be this local file and master file we will be discussing in our subsequent slides. So if master file or local file is applicable for you, you have to prepare that, and also you have to keep proper invoices and the intercompany agreements. Intercompany agreements is something which is executed between two related parties. We have to see that particular related party as an external party itself, and we need to execute a intercompany agreement with that particular party. So we cannot say that it's my company only, so I'm not creating any intercompany agreement. That is not a defensible position. You have to create a intercompany agreement for the transactions or the services which other entity is providing. So there should be intercompany agreements and the master and local files, and everything should be aligned with your books of accounts, and proper monthly reconciliations with VAT, customs, everything should be prepared. So if you adhere to these 4 principles, and also fifth principle, you have to keep all the documents in a proper way. So if you adhere to all these 5 principles, then we say that you are defensible if some audit comes up in future. So these are the 4 key things which you need to keep in your mind while for creating a defensible TP position. I will just go to the regulatory expectations in the GCC region. So there are 6 countries I listed here. So in that, Saudi Arabia is a country which has high audit priority. So Saudi governments, the expectation of Saudi government is more compared to other GCC countries. So if you are someone who is working in the Saudi Arabia, you should have to create a robust TP policies, and you should be taken you should be taken in your mind that there will be high risks for audit in future. So Saudi Arabia is a jurisdiction where the expectation of the government is higher. And in case of UAE, the rules are evolving. We need to wait how the government responds. But when we see the VAT regime, the after effects of the VAT regime in UAE, so there will be liberal nature for the liberal nature from the UAE government. It will not be that much stricter as like in Saudi Arabia or in India. That's what my belief. And then comes to Qatar. Qatar is a country where there is a more documentation focused country, and not that much stricter as Saudi Arabia. So UAE and Qatar are focusing on TP, but not that much stricter compared to the Saudi Arabia. And for other 3 countries, the concept of TP is emerging. So there are no formal laws or formal disclosure form or formal complaints, but the TP is evolving. In future, we can expect TP rules from the government for these jurisdictions as well. And when it comes to the Saudi transfer pricing, so there are 4 compliances we need to do. So when you are working in an organization, there will be 4 compliances, 4 TP compliances which you have to do. One is the TP disclosure form. Another one is the local file. Another one is the master file. And the fourth one is the country by country reporting, CBCR we say. So these 4 compliances, like as a finance manager, you should be aware about the deadlines, and you should be aware that if you are a multinational company, multinational group, then you have to follow these 4 compliances: TP disclosure form, local file, master file, and the CBCR reporting. So you just have to keep in your mind that these 4 compliances I need to do. So now comes to Saudi Arabia. There is a disclosure form is there, local file applicability and master file applicability is there. And also Saudi Arabia is a country where this intra-group services are scrutinized strictly. Intra-group services are scrutinized strictly. So we will be analyzing what is intra-group services in our next slide. So this is about Saudi Arabia. Saudi Arabia is a very, very TP focused country. So there are all the compliances are applicable in Saudi Arabia. And also coming to the UAE, UAE also TP disclosure form is applicable, master file, local files are applicable, and also even if pre-zone entities also need to comply with the TP regulations. Okay, and also we need to do TP for the KMP also in case of UAE. And we just move to another slide. And for other regions, in Qatar, TP rules are applicable, formal TP rules are there. And Oman, Kuwait, and other GCC countries, so there is like transaction with the related parties should be arm's length. That is there, but there is no that much stricter compared to the other countries. So, however, transactions with the related parties may be scrutinized in future. So, even if there are no formal TP rules in these countries, I recommend people from these countries also to have a robust TP policies and also proper TP documentations. So I just put the threshold limits also, so that that I will just quickly run past through. In case of UAE, it is 200 million revenue. This local file is applicable if our consolidated revenue is 200 million. Sorry, UAE entities revenue is 200 million, and the group's consolidated revenue is 3.5 billion. And same threshold applicable to master file. And also in Qatar also, Qatar Riyal 50 million is the limit for local file, and same threshold applicable to local file. And in case of Saudi Arabia, SAR 6 million, if it exceeds 6 million, they need to submit the local file. And also master file is applicable if their group turnover is 3.2 billion. So I'm just putting up the things in here, so you can refer later also this thresholds and all. I'm just moving to another slide. So now I will cover what are the things we need to keep and what are the risk areas which finance managers and auditors should be focused and should be taken care of. So first thing is there is a ESR reporting earlier. So economic substance regulation reporting in UAE. So if your fair analysis differ from ESR, there will be audit risk. So your ESR and the fair analysis should be aligned. That is something. And if any audit picks up tomorrow, what are the things you need to keep to prove that your FAR analysis is the actual one. That is something which I'm going to explain here. So like tomorrow, if audit picks up, you need to prove that your FAR is consistent, right? You are consistent as well as your FAR is accurate. So what are the details and documents which you can maintain to prove that? When it comes to the people, we need to we might be saying that see, key decisions are taken by my parent company. I'm not taking key decision. So key decisions, since key decisions are taken by parent company, most of the profit should be allocated to the parent company. That might be the position which we are taking in the FAR analysis. So in order to prove that senior decision makers and qualified peoples are there in the other country, we need to keep the board minutes and also the organizational charts and job descriptions. It is always better to keep our all our employees list and their job roles. So if a department comes tomorrow, especially in case of India, we have seen that department comes and asks the list of employees, and also they ask the what are the responsibilities, roles and responsibilities, what are the roles and responsibilities undertaken by these employees. So I recommend every one of you to keep at least the name of key employees and their roles and responsibilities, also their payroll records and also their visa status and their presence in the home country, how many days they are present in the home country. Those things you can keep. And in case of functions performed, you can keep the service logs, email trials, and also the timesheets of the employees. Like we can say that this particular function is performed by us. So you can prove that by keeping the timesheets, also the KPI dashboards and reports. And also in order to prove that the assets are physically present in my country, you can use evidence as to official lease agreement, fixed asset registers, and also the licensing of the softwares. So we can say that if the software is owned by particular intangible property is owned by my parent company, then you can use the licensing agreement or software licensing software subscription invoice in the name of your parent company as an evidence to prove that this software is like parent company is the legal owner of this software. So what I was trying to say is that these documents you should have to keep to substantiate your FAR analysis. If department comes up and asks you to justify your FAR, you can provide all these details to justify your FAR analysis. And also your FAR analysis should match with your economic substance regulation filings you have done earlier. So that point also you have to taken care in your mind. And next one is the intercompany agreement. This is one of the most important area which I want to explain in our session. So as I said previously, we need to have an intercompany agreement. We cannot say to the department that both the entities are my entities. Why I need to prepare a intercompany service agreements? So it is not that case. You have to consider it as an independent third party, and you have to prepare the intercompany agreements. So what I'm explaining is that there are certain must-have clauses which authorities will look into your intercompany agreements that I will discuss. So first one is the scope of service. So your intercompany agreement should clearly state that what is the scope of services, what are the things you are providing to your related party for which you are compensated. So that scope of work should be clearly mentioned in your intercompany agreement. So general, like there might be, I have seen in some of the cases that there are vague descriptions which says that general consulting kind of things. So you should have to properly explain what point wise, as much as detail possible. You have to explain what are the services you are providing. And the second thing is the pricing and the payment terms. So you have to clearly mention what is the pricing policy which you are adopting. There are a lot of cost plus entities. So in the intercompany agreement, you can say that we follow a pricing terms of cost plus 5%. This is mentioned as a pricing term in the intercompany agreement. So you can mention either as a cost plus fixed percentage, or you can mention as cost plus arm's length range. Either way you can mention, but it should be mentioned how you are going to compensate them for the services you are mentioning, you are providing. That should be clearly mentioned in the intercompany agreement. Next one is the payment terms. This is very critical point which I want to say. So the payment terms also should be mentioned. If your payment terms is not mentioned in your agreement, what happens? I will tell you.
Ajin, just 1 second. Actually, it is already like 1 hour. So
Yeah.
I'm fine, obviously, but I hope others are also fine. So I think we can continue this. And can you let me know like how much more minutes will be required? So we
I'll be requiring half an hour also. Half an hour.
It's actually very interesting also because this is the first time because, I think many of us have been into this. So shall we continue? Can you give your responses in the chat or
Yeah. So earlier I was not planning for the basic session. Then I thought that since there are a lot of people who are not familiar with the, might be there are people who are not familiar with the basics.
Yeah.
That's why I explained. I have taken, I think, almost half an hour to explain the basics.
no? Yes, yes, it's very much required actually to understand what this is. So yeah, I think from the feedback they have asked us to continue. In case you're not able to, or you have some other thing in between, this session we are actually recording it and we will share the video in the group. Okay. Thanks a lot. Thanks a lot for the response. Yeah, please, Ajin, you can continue.
Thank you. Thank you, Sabiq. So I'll start from where we stopped. So in our intercompany agreement, there should be clear indication of what is the remuneration which we are giving for providing the service. So one example is cost plus 5%. And also the payment terms also should be mentioned in the intercompany agreement. Why? Because I will tell you. This is mostly seen in India. So other countries may also adopt. So there is a concept of deemed loan. So if this is a company, X company, which is situated in UAE, and this is a company, Y company, which is situated in USA. So UAE is providing software development services. Software development services. So the pricing policy is, since the UAE entity is a very limited risk entity, the pricing policy will be cost plus 15% is the pricing policy. Okay, so cost plus 15% is the pricing policy which this UA entity is following. So they have billed. So monthly they are billing. For example, in first month, first, second, third, and fourth month, they have billed. First month they have billed 500. Second month also 500. Then third and fourth month 1000 AD they billed. So what happens is that if we are billing and we are not able to collect this money to UAE, the government will treat that whatever which is uncollected balance will be uncollected balance. So if we are not able to collect this balance within a stipulated period, this uncollected balance will be treated as a deemed loan provided by UAE entity to USA entity, and they will ask for a remuneration. And they will charge a income. They will recognize Just 1 minute. They will recognize notional. They will recognize notional interest income in UA. So, for example, in this case, if we are not able to collect this 3000 AED, 3000 AED, this 3000 AED, this 3000 AED will be treated as loan provided by UA company to USA company, and in the books of UA entity, government will recognize interest, notional interest. For example, it's 10%. They will recognize 300 AED as income, and they will ask corporate tax for this. This is why I'm saying that your payment terms should be clearly mentioned in your intercompany agreements. Otherwise, it will be treated as unsecured loan provided by UA entity to USA, and a notional interest income will be recognized in the books of UA entity, and the government will ask for the tax on that particular income. Since in this UA, this interest is not taxed, but however, in other jurisdictions, this is something which is happening now. It's a very debatable topic in front of the authorities. So we should clearly mention within how much days we can collect the payments, how many days we can collect the payment, and it should not be very higher also. Like, we cannot mention that 180 days or 180 days or 1 year. It should be ideally below 90 days. So if nothing is mentioned, in India, what happens is that department assumes 30 days as the collection period, and after 30 days, they will add the interest. And also another point which we have to mention in our intercompany agreement is that who is owning the IP. We should clearly mention that if due to this work, if an intangible property is created, who will be the owner of that intangible property, because whoever owning the intangible property has a eligibility to claim higher return. So that also we need to mention. If some intangible property is creating because of this arrangement, which entity will be the owner of that intangible property. And also there are some GCC specific clauses we can add to the intercompany agreement, like in Saudi and all, Arabic translation may be required, and also VAT clauses we can add. So to the TP invoicing, VAT will be added, kind of things we can add. And also English language, like you can always have to prepare, always better to have prepare intercompany agreements both in English language as well as the vernacular language. So this benchmarking process, I will just quickly explain. I will not be taking much time for this. So benchmarking is done because benchmarking is the activity which we find our similar comparable companies similar to the business which we are doing. So we will do product analysis as well as function analysis. So there should be the similarity in the service as well as similarities in the functions performed. So we will use database, we will take the companies, and we will do adjustments, and we will find out the results, which is in detail covered in our last session. Since we don't have that much of time, I'm just quickly moving to next slide. Another very debatable issue which all of you have to taken care is the management and head office charges. So this is something which is questioned by authorities. Management charges means, like, there are lot of MNEs which centralize their functions. For example, HR function or IT function. So it's a MNE group, and they have presence in more than 100 countries. So now this UK is undertaking HR functions, UK entity is undertaking HR functions, and also IT functions is undertaken by USA entity, and the holding company is in UAE. So there are 100 members in this group. So for 100 members, all these 100 members, UK entity and USA entity is providing HR and IT services respectively. So since they are providing one services to other entities, right, other 100 members, they have to charge something on these entities, right? So this charge is called management charges. Management charges, or we will say in TP it as intra-group services. So intra-group services is something which is questioned by authorities, especially in Saudi Arabia and all. This if you are having any type of intra-group services, there should be like properly documented, and this is something which is always looked up by the authorities. So this is the concept of intra-group services, and what we can do to keep a defensible position in terms of intra-group services, I will just explain. So what people usually, like what people do, I have seen there are people who charge management fees. Like if the senior management is also involved in the subsidiaries function, there could be the parent entity might be charging some fees for the subsidiaries, like some allocating some of their salaries to these subsidiaries as well. So what happened is that in some of the cases we have seen that this management fees as a percentage to revenue, like 5% to revenue and all. So this WAC and arbitrary percentage which is based on revenue is not allowed. So proper cost logic should be explained before the authorities. We cannot simply put 5% or whatever percentage may be as to revenue. So authorities will take it as, will view it as a method for profit shifting. And also we need to keep all the invoices, and in invoice also we need to properly mention what is the actual service which we have received. So this intra-group services is used as a tool for shifting of profits by many of the multinational companies. So what they do, that if they want to shift the profit, they put some management charges or some kind of service which is not actually provided by them, and we say that this particular charge, this is something which we provided to my subsidiary company, so I'm taking some profits from that country as a compensation, but actually that service is not provided. So here in this case, what OECD guidelines is saying, that we should have to prove the benefit test. We have to prove that whether we are benefited from the services and whether this services is actually performed. So what means benefit test means whether we will be we will pay if it is an independent party also. Would an independent party have paid for the service? If we are an independent party, then we would have paid for this service. That thing we need to analyze. So there should be benefit test properly documented in case of management services. And also when you are using allocation keys, like in our previous example, HR function is undertaken by UK, right? So if you are allocating that particular cost to 100 members in your members in your group, then there should be proper allocation key. So HR we can allocate based on headcount, IT we can allocate based on number of licenses, and legal anything we can allocate based on the hours spent on each entity. That allocation keys should also be appropriate and should be supported. And another, so that allocation key should be taken care. And also whenever we are invoicing to our related party for this charges, clear definition should be given in the invoices, what is actually we performed. General and vague descriptions may be questioned by the authorities. So properly, so in invoice and all, properly clearly mention that what is the service actually we provided. And also keep the email trials, board approvals, and also execute an intercompany agreement with for these services. So, and also, if as per OECD guidelines, shareholder activities also we need to check. So a parent company cannot charge a subsidiary for the shareholder activities which is done by the parent company. So what is shareholder activity means? If I say a very common example, so if the parent company, like parent company, want to consolidate financials at the group level, right? So if there is any cost incurred for consolidating the financial statement, they cannot allocate that cost to subsidiary, stating that because of you uh, I am getting this cost. So this is something which is even done this is something which is done even if that particular subsidiary is also not there, like if there are other entities in the group also. So something which is done as the capacity of the shareholder by the group entity should not, the cost incurred for those activities should not be charged to the other entities. That is the point. So as per OECD guidelines, if shareholder activities are there, the group entity cannot charge its subsidiary, stating that I have done this for you. So shareholder activities, examples like consolidation of financial statements, a group's board meeting, expenses incurred for group's board meeting, all these activities should not be charged to the subsidiary companies. If we charge, the authorities will disallow that particular charge and will be added to our income. So in case of intra-group services, there should be proper logic behind the pricing, and proper allocation key should be there. Proper intercompany agreements should be there, and make sure that shareholder activities are not charged to the company. And in case of invoices and the intercompany agreement, proper description of the detailed description of the what are the services which they have provided, and also need to check that there is no duplication of services. So for example, if group is charging some CFO services, also there is a CFO which is available in local. So what happens is that it's a duplicate services which actually that entity is not requiring. So we cannot shift profit by providing a duplicate services. So that is something also which we need to take care. So there are this management charges, and this intragroup service itself is a topic of discussion for 2 to 3 hours. So my idea is to give you a basic understanding about what are the key points which you need to take care in this intragroup services. So I will move to next slide. Another one is the royalties. Royalties is something. So in case of royalties,
Can I interrupt?
Yeah.
Shabana VC has raised her hand. Do you have any doubt or? Sharbana, you have raised your hand. Do you have any doubt?
No. Actually, I didn't raise. I think it is just by accident.
Fine.
No issues.
Please move ahead.
Thank you. So in case of royalties, what happens is that, so people will create some companies, IP owner companies in countries like Netherlands, Singapore and all. Why they are doing is that they will say that this country, because of lot of tax efficiency in these countries, what multinational companies do is that they will create the IP in Netherlands or in Singapore and all. So what transfer pricing is, they say that we should check, we should do a Dempe analysis, and we should not only rely on the legal ownership of the entity. So I will just explain this with an example so that it will better understand for everyone. What happens is that legal owner of an IP, of an intangible property, legal owner of an intangible property is a Netherlands entity, but that IP is developed, that IP is protected. If something happened to that IP, so funding for that IP, everything is done by USA entity. So when we do Dempe analysis, all these functions are undertaken by USA entity. So what people will do as a profit shifting method, they will do legal ownership to Netherlands, and we say that Netherlands is the legal owner of the IP, and royalty should be paid to the Netherlands entity. So in substance and in the OECD guidelines, when we see the OECD guidelines, the focus should be given to DEMPE analysis rather than legal ownership. So if this IP is developed, exploited, protected, managed by a USA entity, then that particular royalty should be given to USA entity rather than Netherlands entity. So more than legal substance, we need to do a DEMPE analysis to identify which entity is eligible for royalty. So there are a lot of risks which is happening in the international taxation, which this particular return is given more to the legal owners rather than doing a DEMPE analysis. So department will see the DEMPE analysis and will allocate the particular royalty to that jurisdictions, which is after doing a DEMPE analysis. And also another point in terms of royalty is that the local entity is paying significant royalty, but it is suffering operating loss. So their departments may ask a question that you are suffering losses, and then how you can pay royalty for the IP? Because so you are getting something value added from your group. That's why you are paying royalty. So after getting this value added thing also, still you are in loss. How you can pay the royalty? That might be the question. If you are a loss making entity and you are paying royalty, it should be challenged by the department. And another thing also, there are entities which pay royalty as well as they also do lot of marketing expenditures. So there are lot of local advertising expenditure. In those cases also, they will ask the question why you are paying royalty, since you are using the brand of the group. Because of the brand only you are paying the royalty. Since you already have a brand of your group, then again why you are spending lot of for your branding activities? That might be also a question which should be asked by the authorities in case of royalty. So these are the risks with related to the royalty. So what we can do is that we can do what proper benchmarking analysis, and we can analyze the situations in all these cases, whether our entity is a loss making entity and making royalty, and also whether marketing spend is higher compared to our comparables, similar companies operating in the industry still, and we are paying royalty. So these are the key points which department will look in terms of royalty. And proper agreement should also be in place when we are paying royalty. And DEMPE analysis should also be done. So importance should be given more to the DEMPE analysis rather than who is the legal owner of the royalty. And another risk focus is the chronic loss making entities. If you are making losses for more than 3 years, there might be challenges and there might be questions from the authorities that why you are making losses continuously. And also there is a TP principle that low risk entities should not make profit, should not be in loss. So the expectation of the government for low risk entities, like which are just like the offshoring entities or global capability centers, those entities, low risk entities, which are operating primarily for supporting the parent company. Without the support of the parent company, they cannot operate also. So these are the low risk entities. Low risk entities, government's expectation is no loss. That entities cannot be in loss. Also, they are not expecting supernormal profits. So if our entity is a low risk entity, there should not be no loss. Loss department will not accept. Also, department is not expecting any supernormal profit from you. So you have to earn only routine profits. So that is the thing in terms of low risk entities. So if you are a startup and you are into loss, that is fine. Like there could be situations where genuine cases where a startup company in their initial phases, it will be in the losses. So there should be proper documentation which you should be prepared to justify why this loss is there. And also the situation will aggravate when if the losses continues for more than three years, and you should also have to explain why you are operating business more than 3 years into loss. Those questions will ask from the authorities. And also there are some cases where the cost base will be wrong. Because of that also proper markup will be applied, but the entity will be in loss. For example, some people will not add depreciation to the cost base. For example, cost plus 15% is the pricing policy we are following. So this cost, in this cost, we need to include all the operating cost, which includes depreciation as well. So what will happen is some people will not include depreciation in this cost base. Because of that, at a net profit level, the company will be in loss, but they have done cost plus 15% markup on the invoicing which they have done. So these things should be taken care in case of a loss making entity. And if you are a loss making entity, it's always better to have documented why you are into loss, and always you can expect a scrutiny from the authorities if you are a loss making entity. And also another thing is the marketing intangible. This is a concept where like if you are spending too much, if the subsidiary company or a local entity is spending too much for marketing expenditure, authorities will take a position that you are creating a brand for your group company, and they will also ask for a compensation for creation of this marketing intangible. These are very complex topic, I understand, but I will try my best to explain this. So like for example, if it's our subsidiary company or a local company, usually a local company spend 3% of their revenue for the marketing activities. But in case of our company, we are spending something around 25% as marketing expenditure. So department will see this and will come up with the point that you are creating some marketing intangibles for the group. So you at a group level, you are creating a spend. So because of your spend, your group is also getting benefited. So if someone is benefited by your activity, you should be compensated, right? So that way they will ask compensation from your group entities for your activities for creation of marketing intangibles. So that is something which will be questioned by the authorities. So what you can do is that what department and audit department will check is that department will check your sales trend, whether it's benefiting your sales. They may take 3 to 5 years for your sales trend and your spend. If they are not able to corroborate align the sales ratio to marketing spend, there might be a question from the authorities that you are creating some intangibles for your group, and your group should need to compensate you for creation of marketing intangibles. And also we can make controls like which entity is approving the cost, these board meetings, decisions by the authorities, every documentation will help you to sail through this. So another risk is the unsigned or backdated agreement. So always try to have a signed agreement. This, when the department sees the agreement as a draft, they will not accept that draft agreements. So always keep the agreements, invoices, everything properly signed. Also keep the, if unfortunately you are not able to sign it at the right time, then what you have to keep is that you can keep board minutes, board meetings, all these things you can keep it keep it as a evidence instead of like, since you are not having this agreement, signed agreement in place. And another thing is that this TP, VAT, customs, everything should be matched. So if there are any mismatches in your VAT returns and in your TP reporting, TP disclosure form reporting, there are chances that assessment, like scrutiny, will be picked up from the authority side. And also, when you are providing any loan, you have to do the credit worthiness of the borrower. So just simply taking the market interest rate will not suffice in case of loans, especially in the UAE tax jurisdiction. Whenever there is any loans or financial instruments, you have to assess the credit worthiness of the borrower, and accordingly you have to decide what will be the interest rate that you have to charge for this particular loan. So many of the companies will simply take that ESOP or the alternate exchange rate for Dubai plus this margin. So instead, I will suggest to do a proper credit worthiness analysis of the borrower, and after that only determine the margin. And also another thing which is questioned by the department is the volatile markups. So 1 year we are into 15%, another year we are into 2%, another year we are into 25 to 30%. So these things will be, there are chances, if the authority sees that there are very volatile markups by the entities, there are chances that they may pick up for the assessments. And this point I already discussed. Your economic substance report should match with your FAR analysis. That is the thing. So what we can do? So these are the risks which will be which you might be going to face in the future during the stages of audits and all. So how we can properly manage, mitigate all these risks? So there we can tell it as phase 1 and phase 2. Phase 1 is pre-closing. Before closing of your books of accounts, you can make sure that the agreements are properly signed and there is proper intercompany agreements, and whatever points I discussed in that portion which are mandatory in an intercompany agreement is there. All those things you can ensure, and also you can check that whether this interim results match, reconcile the books of accounts with our TP policy, whether it's matching properly, it's followed. And also, rather than doing a year-end true-up adjustments, like fully we are adjusting at the year-end, rather than doing that, we can do monthly or quarterly. So always prepare a monthly reconciliations and follow a monthly invoicing model, so that we can manage our cash flows, everything we can manage. So that monthly method you follow. And after phase 2, after post closing, you can if like, for example, our pricing policy is 15%. Unfortunately, we landed, our margin is only coming 7% due to some reasons, maybe some errors or something. So we need to make it true ups to 15%, right? True up means just adding generating an additional invoice to the related party so that we maintain 15% profitability. So that if sometimes there are cases that margins are not met, in those cases you can do a final true up. And after that documentation part, you can you need start preparing on local file, master file things. So I mentioned the timelines also. Jan to February you can do true ups, March to April you can do documentation, and also after April, August, September months, you can properly plan your tax planning, like tax filing of tax and TP disclosure forms. So this is called evidence and controls. So always keep the board approved TP policy. So keep the board minutes which approved our TP policy. Like TP policy means, like I said earlier, right? Cost plus 15%. So that is a TP policy which we are following. So it should be approved by the board, and that board minutes we should keep. And also always it's better. There are there will be multiple engagements of different teams in this. So so always assign the roles, which department needs to do which role. Those things are CA metrics. It's always better to assign. Also do proper setups in your ERPs. When you are changing your TP policy, or when you are doing a TP policy in your pricings, always do a ERP setup. And also keep the approval logs for significant changes and all. And also check with the VAT returns whether our transfer pricing invoice and the VAT returns match properly. And another thing is that as an auditor, you can check the service logs, timesheets, and also you can check the roles and responsibilities of the employees to understand which all the functions done it in this country and which all the functions done it in another country. And also you can also reconcile the things with the final audited financial statement, whether our TP policy is properly followed or not. And also we should keep all the invoices and all the document in such a way that we will be able to produce it within 48 to 2 or 3 days. So I have pointed out the common red flags. So the most high intensified red flags are management and HO charges, which we discussed in our previous slide, and also the loss making distributors. Like if a distributor is making a loss for more than 2 years, there are high chances that it picks up for the scrutiny. And no substance royalty. So like proper dumpe analysis is not done, and royalty is simply paying to one jurisdiction. And customs TP mismatches, unsigned agreements, loans without credit check, volatile markups. So all those things I put it in this slide, and after this session I will be sharing this slide as well, so that you will be better understand the things. So the risk metrics I have filled, which is having high priority risk, high critical risk. So this 0.1, 2, 3, 8 and 9 are highly critical, which you need to take care. Since the time is I'm running short of time, so just quickly running things. So next slide is governance and RACA metrics. So there could be some 5 activities which every organization needs to do as part of their transfer pricing. One is TP policy ownership, like creation of the TP policy. It is responsible of the tax department, tax and TP lead, and it should be informed to the finance, control, legal teams, treasury team as well, because this TP policy will affect our cash flows in future, and also the cash flows and also the profitability and how other entity is remunerated. All these things will be affected. So it should be properly communicated with other entities, and responsibility should be taken by the tax lead. And price setting and proper invoice workings should be prepared by the finance and control team, and it should be consulted, and it should be also the responsibility of responsibility of tax lead. Tax team should ensure that finance and control team is properly following the TP policies while they are invoicing to the related party. And also in intercompany agreements, it is the responsibility of the legal team to draft a proper intercompany agreement, and it should be consulted with the tax and finance team. And also the benchmarking analysis is usually done by an external consultant, but it should be responsibility, it should be like tax team should be accountable in the organization for that. And the disclosures and filings should be the responsibility of the tax lead, and it should be consulted with the overall finance manager and also other business units. So final checklist. So we should create a proper document. So master file group and local file, whenever it's applicable, please create those files. And also intercompany agreement should be there, and also properly documented invoices and properly documented TP policies. And also second one is the benchmarking analysis. Proper benchmarking studies should be done. So like yearly we need to do, and in UI there is a relaxation that we can do benchmarking once in 3 years. Like we need to update the data on every year, but the full-fledged benchmarking exercise need to be performed only once in 3 years, unless there is any significant changes in the business of the entity. So benchmarking exercise should be refreshed. Like yearly updation should be there, and calculation should be verified, and especially proper care should be given to loss making entities, and proper justification statements should be prepared, so that why we are into losses. And to prove the substance of the FAR analysis, we should keep the board minutes. Also, we should keep the roles and responsibilities of the employee. Also, we need to create a document which explaining the reporting mechanism in our organization. Also, we need, in case of intangibles, we should do a dump analysis to identify which entity is developing this intangible asset, and also which entity is managing this intangible assets. And there should be also operational controls. So there should not be mismatches between our VAT returns and the TP returns. So it should be properly reconciled, and also invoice should properly explain what is the service which we are providing. So, and year-end TP adjustment, if our margins are not meeting, it's not meeting, and also it's not as per our pricing policy decided, then we have to do a true up at the year end. We have to raise a invoice to the related party for the differential figure. So those things we need to do. And also proper data room should be prepared. Like all this, create a folder in your computer for transfer pricing, and create and save all these details which I have mentioned earlier in such a way that we will be able to produce it at a real-time basis, or even with 1 or 2 days. So authorities usually give us 30 days to present these things. So that's all about the TP session. Since we are lacking time at the end of the session, I just made it in a very quick manner. So if anyone, this is all about the session, and if anyone having any doubts, I'm happy to address that. So it's over to the participants.
Yeah, I think thanks, Ajin. I think if you have doubts, you can directly ask it now itself. There are a couple of doubts in the chat session. Can you check those? With regard to stock transfer, whether TP is applicable in case of obsolete stock. That was one question which raised. And if you have any other questions also, you can ask. Just want to tell you that we have kept this session at this time, considering our friends in Qatar, because this group evolved from Qatar actually. That is why we started at like Indian time itself, 9:30. So that is the reason why. And we thought to have it on a weekday so that it does not interfere your weekend holiday mood. So if you have doubts, you can ask. It's a very vast topic, isn't it? As in each
Yes,
session,
it's a very,
each topic, I think itself is like 1 or 2 hours you can speak.
yes,
And
yes.
it is very complicated, and I think, as you said, very clever companies might be using this to evade taxes, isn't
Yeah,
it?
we can make it as complex as the authorities. So if we are having a good TP professional, we can use it as a tax planning exercise also. It's like there are a lot of companies which are into like multinational companies. They do this as a tax planning exercise in terms of creation of IP and all, which I said that if you see many of the multinational companies, the IP will sit on the Netherlands or Singapore. So if they sell that IP to another entity, this capital gain taxes will not be there. So all those things are there. And also we need to link this TP with the double taxation avoidance agreement, so that there will be a lot of benefits and we can use this TP as a tax planning exercise.
Nice.
So there is a doubt of stock transfer for the job work. So since it's not directly affecting our P&L, like so directly affecting the P&L of the entity which is sending the goods, it will not directly impact the transfer pricing. But if some job work is done by that particular company, one service they are providing to the another company, right? That job work service. So for that service, they have to be compensated. That is the thing which comes to the TP. And also if it is not affecting any of our financials, or if not affecting our tax base, taxable profit, there is no tax avoidance from a particular transaction, then the transfer pricing will not be applicable. So the basic principle we need to analyze that due to this transaction, is there any possibilities of tax avoidance? So the basic principles of the transfer pricing itself is that to meet to counter the tax avoidance. So if this particular stock transfer is not creating any tax avoidance and it's not affecting our taxable profit, then transfer pricing will not be applicable. But if in such a way that it is affecting the profit, then the transfer pricing will be applicable. So it should be evaluated case to case, and it's very subjective thing. So first of all, first thing we need to understand is that transfer pricing is not an exact science. Like when we take the corporate tax law, or when you take the goods and services tax law, there is a clear mentioning in the law itself. There is clear guidance from the law itself that this should be done in this way. So there is nothing related to TP which states that this should be done in this way. So it's case to case, and it's not an exact science. Only guidance which we have is the OECD guidelines, and also the previous rulings of the courts and previous positions which departments taken. And it's case to case, it's differ. We need to analyze subjectively.
Yeah, I think even finding comparable companies itself is not easy. Like in our case, we are dealing in wholesale to wholesale, and we are finding it very difficult to find similar companies, especially in UAE. And even if we find some company in maybe through that software, we are not sure whether they are doing the exact business that which we are doing. Maybe they are doing some other value addition to the product, which we are not aware of.
Yeah. So that is a very key problem in the GCC market, where unlike India, the public like in India, previously we have audits. Since from decades we have audit, we are filing with MCS and all. But in case of UAE and GCC countries, this regulatory aspects came very recently, and the annual filings were not applicable. So it's difficult to get the companies in the GCC regions. So what we usually do is that when we are not able to get the companies from the GCC region, we will also include the MENA region as well as the Eastern Europe region to our benchmarks, so that we will get a proper comparable companies. And if there are any minor differentiations, it's not an issue when we select transactional net margin method. Transactional net margin method is a method which allows flexibility. So if there are similar companies which are doing little bit of different functions also, we can take it as a comparable. So it's like best comparable. That's it.
Yeah. Sabiq, you have raised your hand. You have any doubt? Not me, the other Sabiq.
Hi, Ajin. Thank you for the presentation. Actually, I missed
Thank you, Sabiq.
just one question. Like, if a company decides to, for their internal reporting purposes, they are keeping it on cost basis. Like, they are not making any markup. And they have done the benchmarking and TP study and taken the consultation from from a reputed consulting firm. When they file the tax return, as per the benchmarking report, the all transactions are identified, and accordingly the invoicing and the markup, all those have been done as per the ALP identified in the report. In that case, it will be okay. That is one question. And if everything goes right, how the government take, I mean, is there any approved list or something like, these are the consultants, or we can take from any consultant? How is it the, UAE market?
Yeah, good question.
So what I understand from your thing, your question is that, so the companies followed a TP policy of cost to cost basis. Later they done a benchmarking study, and they identified that this much margin should be charged, and then they do a true up. Like after before finalizing the returns, they have done an extra additional invoicing, and they done markup to that. This was your doubt, right, Sabiq?
Yes, yeah.
Yeah, there is no issues. We can do true ups. So in my session also, I was saying that. So if our policy is cost plus, so the arm's length range is cost plus 15%. Unfortunately, we were not able to get that percentage by December end. Then after audit, we understand that this much margin I should have to keep, but unfortunately I was not able to keep that margin. Then you can definitely do a true up. So ultimately, authorities will check at a final level on which profit you paid the tax. That's what authorities check. So like there will not be any issues for that. Practically, like there are a lot of situations people are doing this because transfer pricing is a new topic. So many of them are not aware. Maybe they get aware of these topics when the audit comes up, like statutory audit comes up and all. So there is no issue. You can do a year-end true-ups, but as a best practice, always do it in a monthly basis. If you have sufficient profitability, there will not be any questions from the department. And there is no consultant. Coming to your second question, there is no consultant which we can say like consultant which we can say that which is suggested by the authorities. Everyone who knows the transfer pricing, which use the proper database, TP Catalyst is one which we use database, then you can take consultation from them. So people like how it happens in the GCC market is that there are a lot of firms there are big fours are there. Big fours do consulting to the M&E groups, and there are other companies who are specialized in the TP, like SPC Steadfast is one company which is operating in UAE, who are highly fully specialized into transfer pricing, and they do B2B deals. So if your consultant is not doing transfer pricing, then these firms will assist. Like I personally do a lot of consultations. Like I don't have any presence in UI region, but I work with other auditors and accounting firms on a B2B basis to consult transfer pricing. So we provide services from India to UI region, UI consultants. So I don't have any direct clients in UI, but how I provide consulting is it's on a B2B deal.
Okay. See, for example, now the e-invoicing have come in UAE. There is a approved list of vendors where you can take for the services. So that way, nothing
like that in case of transfer pricing.
That is one thing. And if normally in the market, TP study is a very costly affair. So when we take some assessment, the report based on which we take decisions, and later if the authority
that I can explain why TP study is costly is because of the software. The software which we are using for benchmarking it's nearly cost around some 60 to 70 lakh rupees.
Yes.
So that is the reason why this TP service is costly. So only and large organizations can do this TP analysis. So their rate will be premium, and also there is a significant cost which is involved in this as a software cost. So ideal margins will be the 50% for the TP consultants. The rest 50% will be assumed by the TP softwares.
Yes.
In
Okay.
India, that much cost will not be there because the cost software is cheap.
Sure. Thank you.
Can I ask one question with regard to like what Sabiq asked? Sorry for extending this a bit. Just a big, very common question actually. Like in what Sabiq said, for example, a UAE company is billing to Saudi Arabia at cost to cost because that product needs to be available in Saudi Arabia at a very competitive price, and it is an industry where competition is also very high. Okay, so in the case which Sabiq said, or what I understand, if you are doing a true up, you're actually paying taxes on profits not earned, isn't it? You are saying that this is actually to be sold at 15 riyal. I sold it for 10 riyal. Now for that additional 5 riyal, I am going to pay taxes. And especially when the volume is very high, like for companies which are the turnover is in billions, I think this value will be very high. Second thing, sorry, third thing, so you are paying additional taxes, and that company in Saudi Arabia, based on what product they received and what they sold, they are also paying obviously taxes in Saudi Arabia. So you are paying some tax for which profit you have not earned. Is it that way if you are doing this kind of exercise? This is a practical scenario which came
understood. Yeah, understood. So basically the thing is that so we need to characterize both these entities. So either as one low risk entity or a high end entity. So the concept is that if this particular, in your case, if this particular UA entity is just created only for only for selling the goods to Saudi Arabia, and it's like the primary risk holder and the primary ownership comes to Saudi Arabia entity, then what we have to do is that then this UA entity will come as a limited risk entity and Saudi Arabia entity will be come as an entrepreneurial entity. So in that cases, this limited risk entity should be at a profit. So we have to apply some margin on that, and whatever losses coming after this can be borne by this entrepreneurial entity. So the UA entity should be in profit and Saudi entity can be in loss. There is no issue. That is one case. If both the entities are equal in terms of entities are equal in terms of the functions and risk performed, and we are not able to characterize one entity as a low risk entity and another entity as an entrepreneurial entity, we can use instead of transactional net margin methods or other method, and we can justify that this is a scenario as per the market conditions we have to use this. That way we can convince. So it's basically that way. So it's basically we need to properly document. It's all about documentation. If we are able to justify that this is the market situation, this is the exact reality in the market, then we can use other method and we can justify that this is an arm's length. Okay. It's all about how we properly document the things in our TP benchmarking report and TP local file. So if someone which is very low risk entity, the common principle adopted is that low risk entity should be in profit, but it should be minimal profit, not to be supernormal profit, and the other entity should be. If the entities are equal and the market conditions are same, it's like due to some control, due to some jurisdictional law or some proximity to the jurisdiction, we have created another entity. Both entities are equal. So in that cases, it's fine. Like we can sell it to on cost to cost basis also.
Okay, thank you. I think Mariam Bibi has some doubt.
So it's basically how we put the things in a most explainable manner before the authorities. So there is
Okay.
no hard and fast rule. If
Fine, fine.
in reality we were not able to justify using T&M, we can use other method.
Hi, Mr. Ajin.
Hi,
Thanks
Mariam.
for this session. It's really informative. It was very useful. Thanks. Really appreciate this session. I just have
Thank you.
one scenario. Just wanted to understand how TP rules and regulations will apply for that. Consider two related entities for which this TP is applicable. One entity is located in a tax country where the tax percentage is 40%, and the other related entity is located in a maybe low risk entity or a low tax percentage, like for example in Qatar 10%. So in this case, the other entity has done some transaction with the Qatar entity, and it's like they have followed all the TP rules and regulations, and they have done these transactions, and the Qatar entity has booked this sales, and they have booked it as a receivable. Like they have to get this amount from the other entity as a receivable, and after some point of time the other entity is going to get liquidated. In this case, they want to write off all these receivables which they have booked in the Qatar entity. So
Okay.
in this case, can that Qatar entity, even though they have paid that 10% tax, can write off everything in 1 year, which is a huge receivable from the other related entity, or any transfer pricing provision should be checked into it to validate these transactions?
Writing of receivables, right? So
Yeah.
earlier we paid the taxes, right? And now
Yeah.
that particular entity is liquidated and we are writing off it, right?
Yeah.
So there
But the
will be no
tax
issue.
is also shifted, like 30 or 40%, instead of 40% in the other entity, they have moved the sales to the lower tax payable entity, and only 10% tax was applicable on that, and it has been paid. But now the other company is liquidating. Is there any connection with these two to be checked as respect to transfer pricing, or we can do that write off of receivables?
We can do that, right? Because we can do that, right? So we need to keep proper documentation for that. So what happened is, in your case, is first 10% taxes paid by the Qatar entity. Once
Mhm.
you reverse it, so it will become as an expense in your books of accounts, right?
Yeah.
Qatar's books, right?
Yeah.
And similar way, it will be taxed in that 40%. 40%
But they are going bankrupt and liquidating, no? So they will have that liquidations things, and in that only the creditors will be on the top priority to be repaid back. So related
Yeah,
party.
yeah, in that case, if like we can do that as well. There is no issue because it's a genuine case, and we need to keep patient status of that particular entity. I mean, might be this will be picked up by audit by authorities.
Yeah.
So we can there is no harm for doing that because it's a genuine thing. We need to do that. And that particular entity is not getting anything benefited out of that, because once we receive the cash, then only we can treat it as income, right? So we can treat it as an expense. There is no issue, but there are chances that it might pop up in the like in it might pop up in
For
the
assessment.
audits, and you need to explain. So liquidation is some case, like in normal cases without liquidation, it will be taxed in that country, so there will not be any tax avoidance. But in your case, it's fine because we can't do anything on that, right? So it's fine.
Okay, thank you.
We need to properly document. That's it. From transfer pricing standpoint, there is nothing. Might be in India there are some aspects from the FEMA's point of view while writing off the receivables. Transfer pricing, nothing is there.
Okay, even though the receivable write-off is major, if we get all the board resolutions, we can write it off. No, nothing related to TP. We have to verify it, right?
Yes, because nothing you can do because
Yeah.
you need to write it off. That's the thing, because you ultimately, so if you see the Qatar's tax jurisdiction, so you paid the tax, and tax on an income which is not actually received by you, right? Later point you can reverse it that back.
Okay. Thank you so much.
Yeah, so if there are no any other doubts, I think we can wind up. Yep. So I don't know how to thank you, Ajin, and all the participants, because this is like maybe, you know, me and maybe one or two of my friends who helped me in conducting this session. I know there are a lot of it's not like a very professional session or a kind of setup. Apologies for any drawbacks. Hopefully we'll be having more sessions in future, maybe with regard to transfer pricing itself or some other sessions, because staying updated, being, you know, knowledgeable about what is happening around, skills, etc., is very important nowadays. Competition is very high. It's not like, I think, how it was maybe 10 years before. So let's
And also, just to add one thing, also some new concept is taking care in terms of international taxation, which is BEPS, minimum tax of 15% for MNE groups.
yes,
That is going to be the next hot topics. Which
yes, yes. And I think compliance is going to be even more stronger. Like maybe Qatar will adopt that. So it is
yes.
not.
So in
easy.
future, I think every country will keep a tax rate of 15%. There
Correct.
is a global pressure from the side of global pressure on from the countries to
Yes,
keep every country at least 15% as their corporate tax.
Yes. So inshallah, we'll be having sessions in future also. Thanks a lot to all of you for joining this session. You know, it's quite late night, especially in India. Yeah, thank you once again. Bye bye. Good night.
Thank you all. Bye bye.